everyone, I'm Ingrid Tyrant, economist and applied futurist at Cutting Edge Consultancy, LLC. The Fed just released their September 2025 FOMC minutes, revealing a divided committee amid softening jobs and sticky inflation. Could this signal more rate cuts or a bumpy road ahead? In this video, I'll summarize the key points, analyze the economic impacts, and share my predictions. Fair. Let's dive in. Subscribe for more insights. Summary of the Fed minutes. The Federal Open Market Committee, FOMC, met on September 16th to 17th, 2025, and decided to cut the federal funds rate by 25 basis points to a range of 4% to 4.25%. This was the first rate reduction of the year, reflecting increased concerns over labor market risks while inflation remains elevated. Key discussions included: 1. Economic activity. GDP growth moderated in the first half of 2025, with Q2 showing a rebound but overall slower pace. Consumer spending and high-tech investments supported growth, but housing remained weak. Foreign growth slowed, partly due to U.S. tariffs impacting partners like Canada. 2. Employment. Labor conditions softened. Unemployment rose to 4.3% in August. Job gains averaged weekly, and revisions showed payrolls 900,000 lower than thought. The job vacancies to employed ratio held at 1.0, indicating balance, but with downside risks from AI adoption and low immigration. 3. Inflation. At total PCE, inflation hit 2.7% and core at 2.9% for the year ending August, driven by tariffs. Progress toward 2% stalled, with upside risks noted. 4. Financial markets. Yields fell short-end by 40 bps, equities hit records, and the dollar stabilized. Repo rates rose due to Treasury issuance, but reserves remain abundant. 5. Risks and projections. Downside risks to employment increased. Upside to inflation from tariff. Star forecast. GDP growth revised up slightly for 2025 to 2028. Unemployment above natural rates short term. Inflation back to 2% by 2027. 6. Policy action. Almost all members agreed on the cut, but views divided. Some favored no change due to inflation concerns. One preferred 50 bps. Balance sheet runoff continues. No preset path. Data dependent. The minutes highlight a shift with employment risks rising. The Fed is pivoting toward easing but cautiously amid tariff-driven inflation. Q data from the minutes. Here's a quick table of the staff's economic projections changes from July, in parentheses, variable 202-5202-62027. 2028, longer run GDP growth, 2.0% plus 0.12.2% plus 0.12.0%, 2.0%, 1.9% unemployment rate, 4.4%, 0.14.3%, 0.14.2%, 4.2%, 4.2%, PCE inflation, 2.7%, 2.7%, 2.0%, 2.0%, 2.0%, core PCE inflation, 2.9%, 2.4%, 2.1%, 2.1%, 2.0%. These show optimism for growth pickup post-tariffs, but near-term inflation bumps. Analysis. Impact on the U.S. economy. This rate cut eases financial conditions, potentially boosting spending and investment amid moderating growth. Lower rates could support a soft landing by cushioning the labor market, with unemployment at 4.3%. Further weakening might tip into recession, if not addressed. However, tariffs are a wild card. They've pushed inflation up, muting disinflation progress and risking persistence into 2026. Sectors like agriculture and housing face headwinds. While high-tech thrives, positive impacts. 1. Consumers and businesses. Cheaper borrowing spurs spending. equities rose to records, post-meeting, signaling confidence.
2.
Global spillover, weaker dollar aids exports. But foreign slowdowns, for example, Canada could drag. Negative risks. 1. Inflation stickiness. If tariffs embed higher prices, the Fed might pause cuts, prolonging high rates and slowing recovery. 2. Labor vulnerabilities. Downward revisions suggest softening started earlier. AI and policy uncertainty could exacerbate job losses in sensitive groups. Overall, the economy remains resilient, but divided Fed views highlight uncertainty, a balanced dual mandate approach. But with employment, now the priority. Predictions. What's next for rates and the economy? Based on the dot plot. Most officials see 2 more 25 BPS cuts by year-end to 3.5 to 3.75%. But 7 foresee none, showing caution. Markets price in 3 cuts, implying a faster easing if jobs data worsens, for example, October report. My take as an economist. 1. Short-term. Q for 2025. 50 to 75 BPS more easing if unemployment ticks up. Pause if inflation exceeds 3%. 2. 2026 outlook. GDP accelerates to 2.2%. Inflation eases to 2.3%. But tariffs could add 0.5 to 1% to prices. Watch for policy shifts post-elections. 3. Risks. 40% chance of mild recession if labor demand drops sharply. Soft landing likely with productivity gains offsetting AI disruptions. From my AI models, expect volatility in emerging markets tied to as Bronner's policy. Some countries could benefit from a weaker dollar. Outro and CTA. That's the Fed Minutes Breakdown. A cautious cut amid dual risks. What do you think? More cuts coming. Comment below, like and subscribe for weekly economic insights. See you next time.